Welcome, everyone, and thank you for joining our event, Navigating Life Changes. Today, we'll be focusing on financial strategies for expats here in Switzerland. So, I'm David Rosbotham. I've spent over 15 years in financial services, nearly 10 of those based here in Switzerland. And I founded Rosbotham Finance to do one thing well: strategic financial planning for expats and internationally mobile professionals. So, we're an independent, we're fee based, and we specialise in cross border planning, focusing on retirement, pensions, tax strategy, and helping people navigate through the kind of life transitions that we're about to talk about today. So, I want to start with something that might be uncomfortable, but it's important to hear. Every major life decision you make as an expat living in Switzerland, changing jobs, relocating, buying or selling property, has a financial dimension that most people simply don't see until it's too late. And the cost of not seeing it is almost always higher than you'd expect. So today I'm going to walk through the three transitions that catch expats out most often, and I'll leave you with a question at each stage that I hope will change the way you approach these decisions. Here's the pattern I see again and again. An expat decides to change jobs or move back home or buy a property, and they plan the life change first, then deal with the finances afterwards. That feels logical, right? Well, the problem is that Switzerland's financial system doesn't work like your home countries. The rules here are specific, technical, and sometimes counterintuitive, and by the time most people discover what they should have done differently, the window to act has already closed. So today, I want to reverse that pattern. I want to show you what to think about before you commit. Before we get into the three transitions, let me quickly set the context. Switzerland runs on a three-pillar pension system. Very simply put, pillar one is your state pension, pillar two is your employer pension, and pillar three is your private tax advantage savings. This structure creates obligations and opportunities that simply don't exist in most other countries. On top of that, your tax treatment can vary depending on which canton you live in, your residency status, and whether you're moving within Switzerland or crossing a border. Cross-border rules add another layer of complexity, and they're repeatedly overlooked, even by Swiss financial advisors. And let me give you a quick example. So the Pillar 3A, an excellent tax-deductible savings tool. Most of you have probably been offered one while you've been here, but the type of 3A matters enormously if you're an expat. An insurance-tied 3A, the kind offered by providers like Swiss Life or AXA, they're designed for someone who will live in Switzerland until retirement. If you leave, you can technically continue contributing, but as a 3B. But you lose the tax benefit entirely, which was the whole point. And if you want to stop or withdraw, you face the surrender penalty. A bank or an investment 3A gives you the same tax benefits whilst you're here, but with no commitment and no penalties if you leave. Now, here's why this matters in a cross-border context. If you move to the UK at age 55 and you keep on paying 7,000 Swiss francs a year into a now useless 3B, you're missing out on contributing to a UK pension instead, where you'd get up to 40% tax relief. Over 10 years to retirement, that roughly equates to 28,000 in potential tax savings that you've walked past. One product choice, made without considering what happens when you leave, could easily cost you 28,000 francs in missed tax relief. This isn't a reversible decision, and this is why generic financial advice doesn't work well here. The detail matters, and in Switzerland, the detail is designed for residents, not expats. Nobody wants to think about redundancy or unemployment, but it's become one of the most important conversations we're having with clients over the past 24 months. The job market for expats in Switzerland has shifted significantly. AI is reshaping entire industries. The UBS and Credit Suisse merger displaced thousands of international professionals, and across sectors, expats have been disproportionately affected by restructuring. Now, I've met with expats who've completed their full time on the chômage or the RAV, the unemployment system, and they're still without work. They're now living off savings on autopilot, no plan for how long the money lasts, no clear picture of what's been depleted each month. And this is where financial planning becomes critical. Knowing your expenses isn't just good practice, it's survival. So how much of your savings disappear each month while you're out of work? What's the impact on your retirement assets? And at what point does staying in Switzerland actually become more damaging to your overall financial plan than leaving? If you've been made redundant, your severance package almost certainly has tax implications, and in many cases, those terms are negotiable. But you have to know that before you sign, not after. And this is something I feel really strongly about. So, if redundancy is on the table, you should walk into that conversation knowing exactly what to ask for and what to push back on. How will your pension be handled? How your notice period is structured? And what terminology is used for your departure can all have a knock on effect financially. These are not details your employer will always raise with you, but they can make a significant financial difference. And once you've signed, the window closes. And for those over 55, redundancy triggers a very specific set of pension rules that can work in your favour or against you, depending on whether you're preferred. Here's my first question for you. I'd encourage you to sit on it for a moment. If you change jobs tomorrow, whether by choice or not, do you actually know what would happen to your second pillar? Most expats I speak with don't. They don't know the vested benefit options, they don't know the fees involved, and they often don't realise that a gap in employment can affect their eligibility for unemployment insurance. When you leave an employer in Switzerland and you're not going straight into another position, your second pillar pension moves to a vested benefits account. The default account is rarely the best option, and most people never compare providers. As well as your second pillar, it's important to think about employee stock options, gardening leave, negotiating your redundancy package, and what you can do to be tax efficient. The financial difference between a well planned job change and an unplanned one can be genuinely tens, if not hundreds of thousands of francs. The second transition is relocation, whether that's moving back to your home country or onto somewhere new. And the key thing I want you to understand is that leaving Switzerland is not a single event, it's a chain reaction. So your tax residency doesn't end the day you get on the plane. Your pension access depends on where you're going. EU versus non EU destinations are treated differently. Your insurance obligations have their own timeline. And the timing of all of this matters enormously. Which tax year you leave in and which canton you're registered in when you make your pension withdrawal, both of these can significantly affect how much money you actually keep. Now, something that still surprises many expats, when you leave Switzerland, you actually have the option to withdraw your pension capital. And in many countries, the UK, for example, you can't touch your pension until retirement age. Switzerland is different. But just because you can withdraw doesn't mean you always should. Whether you take the money, leave it invested, or move other assets first, that decision depends entirely on your destination, your tax position, your age, and the rest of your financial plan. It's not a default action, it's a strategic one. Second question. If you leave Switzerland next year, do you know which country would tax your pension withdrawal? This is something that surprises a lot of people. So many expats assume that when they move home, their home country's tax rules just switch back on automatically. They almost never do, and at least not the way you'd expect. So double taxation agreements exist between countries, but they're complex. They vary by country, and getting the sequence wrong can mean you end up with a very unpleasant tax bill. However, with careful consideration to cross-border planning, you could see a significant saving in taxes. The third transition is property. And if you're thinking of or have used your Pillar 2 to help you buy a property here, and many expats have, that decision actually comes with long-term consequences for your retirement that most people never sit down and actually calculate. So, did you know when you use your Swiss pension as part of your deposit, any future voluntary buybacks into your second pillar will not be tax deductible until that amount has been paid back? Why does this matter? Well, nobody really wants a big tax bill, and when used correctly, voluntary contributions to your second pillar are one of the most effective ways to reduce your tax liability in Switzerland. But if you've withdrawn pension capital for property, you lose that advantage until it's repaid. This also connects back to career changes, and I often see expats who receive a redundancy payout and put it straight into their second pillar because that's what a friend or a colleague may have done, only to discover on their next tax return that the buyback wasn't tax deductible because they hadn't repaid the amount they withdrew for their property deposit. By then, the money is locked in and the opportunity to put it somewhere more effective has disappeared. And remember, if you make a voluntary buyback, you cannot withdraw pension capital for 3 years. Otherwise, the tax deduction is reversed. Every decision connects to the next. So if you're selling the property, capital gains tax applies, and the amount depends on how long you've owned the property. So timing a sale around a major life change isn't just about the property market, it's actually about your tax position too. And if you're thinking of leaving Switzerland while you still have a mortgage, be aware that most mortgage agreements include residency conditions. So your bank may require early repayment or renegotiation the moment you're no longer a Swiss resident. Finally, if you leave Switzerland but you keep a property here, you will usually still need to file a Swiss tax return related to that property. Leaving the country doesn't always mean leaving the tax obligations behind. The third question, if you're planning to relocate or repatriate, let me ask you something. Do you know the most tax efficient sequence of events? Does it make sense to sell your property before you leave Switzerland or after? The answer isn't always straightforward, and there can be a financially correct decision, and then there can be a personal preference. But knowing the tax implications is still key. Do you know the double taxation agreement between Switzerland and your new location? Because that agreement determines how your pension, your property gains, and your income are taxed, and by whom. Have you thought about what happens practically if your property sells while you're still a resident here? So, can you find a rental for 6 to 12 months while you transition? Have you budgeted for that? And here's the one that really catches people out. What if your plan was to sell your Swiss property to fund a new home in your next country, but that property doesn't sell? And your second pillar is locked for 3 years because you made a voluntary buyback. Where does the cash now come from? How does that affect your ability to move, to buy, and to live? These aren't hypothetical situations. These are conversations I have regularly with clients, and the answer is always the same. You need to map the full sequence before you commit to any single step. Let me give you a simple framework. 3 rules I encourage every expat in transition to follow. Rule number 1, understand first, decide second. Get a clear picture of the financial implications before you commit to the life decision, not after. Rule number 2, never assume Swiss rules work like your home countries. The pension system, the tax treatment, the property rules, they're all specific to Switzerland. Verify every assumption. And rule number 3, sequence matters. The order in which you do things. Resign, withdraw your pension, move, sell your property can change the financial outcome dramatically. The right steps in the wrong order can cost you. And one more thing worth mentioning, your Swiss mortgage advisor or your bank may be excellent at what they do within Switzerland, but they're unlikely to understand the international landscape if your situation crosses borders, and for most expats it does. You need someone who looks at your assets in a cross-border context, not just a Swiss one. Now, let me show you what the difference between taking advice and not taking advice actually looks like in real numbers, because I think this will land the point better than anything else I've said today. So on the screen, you can see 2 clients, both aged 58, both worked in Switzerland for 10 years, both accumulated around 700,000 Swiss francs in their second pillar and 70,000 in their pillar 3A. Both received a job offer in their home country, Denmark. Client A took advice. She negotiated the terms of her departure with her employer, including how she accessed her pension, which was structured as a retirement lump sum. She created a plan to leave on a specific date, withdrew her second pillar and pillar 3A while still a Swiss resident, and paid around 8% in local Swiss withholding tax. She was then able to reinvest in line with her new life in Denmark. Client B never had time for advice. Work was too busy. He left Switzerland and his employer moved his pension to a vested benefits account automatically. He left it there, uninvested, and moved to Denmark. 5 years later, after being made redundant, he decided to withdraw his vested benefits as a lump sum. He took no local advice in Denmark. Here's what happened. A Swiss lump sum pension withdrawal is generally treated as a fully taxable personal income in Denmark if you're a tax resident there. Denmark does not treat foreign lump sums favourably. While the payout was taxed at source in Switzerland, Denmark taxed it again as personal income. In his case, because he had a very well paid package during the course of the calendar tax year, the effective rate was around 60%. So client A paid roughly 56,000 francs in tax on their Swiss pension assets. Client B paid roughly 420,000. Same pension, same destination country. The difference? Over 360,000 Swiss francs. One careful exit strategy, that's all it took. And that's the difference between planning ahead and figuring it out later. What to remember, key takeaways. So, the financial side of every life decision you make is more complex than it looks. Like most countries, Switzerland's framework is designed for people who are born here and who will stay through retirement, not people who are internationally mobile. The biggest risk isn't the wrong decision, it's the right decision in the wrong order. You don't need to be the expert, you need to talk to one. And the most expensive mistakes expats make in Switzerland aren't the ones they get wrong, they're the ones they never knew to ask about. I've worked in this industry for over 15 years, and I understand that for many people, the idea of financial planning carries some baggage. Maybe you've had a bad experience in the past. Maybe somebody tried to sell you a product or push you into an investment you didn't necessarily need. But what I hope today has shown you is that financial planning, real financial planning, isn't just about products. It's about creating a financial roadmap, one with multiple scenarios, so that whichever direction life takes you, you already know the way. It's about preventing those moments, the ones where you say, I wish I'd known that earlier, or the ones where you realize the outcome you got wasn't necessarily the outcome you had to get. Every scenario we've talked about today, if you think about the redundancy, the relocation, the property decision, the pension withdrawal, in every single case, the costly outcome and the good outcome started from the same place. Same pension, same country, same life change. The only difference was whether somebody planned before they acted or figured it out after. There is no product, no strategy, and no advisor in the world that can fix the decision that you've already made. The only thing that changes the outcome is knowing what you're walking into before you walk into it. So thank you very much for watching. If you have any questions, drop me a message. And if you know of any expats who might benefit from hearing this, I really appreciate you sharing it with them. Thanks again, and see you soon.